You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com. You wanted it, you got it. A radio program that helps teach you options trading inside and out, basic to complex. This is Options Bootcamp. Whether you want to learn how to protect your portfolio, generate income, or even become a master of volatility, the Options Bootcamp drill instructors will break it all down for you. Now, let's get you into peak options trading shape. Here are your Options Bootcamp drill instructors.
All right, everybody. That music means we are back on Education Wednesday. Yes, the day here on the network where we take on all comers in the world of options education. We kick things off with the premier options educational program. Yes, it is time for Options Bootcamp. My name is Mark Longo from theoptionsinsider.com, as well as, of course, from the ever exciting Options Insider Radio Network. Reminding you out there, if you haven't embarked with us yet, I know a lot of you have, but if you haven't joined us yet on the journey on the Plus and the Pro, you're missing out on a whole bunch of fun stuff. We just had Pro Q&A number 6. Hard to believe we already are at number 6. Seems like we just kicked this whole thing off a couple of days ago, and we kind of did, but we're already up to 6 there. Options oddities, whole bunch of other fun stuff. You know, if you join after the fact, it's not too late. You can still access those as well. You can get your own exclusive podcast feeds. You can check out all those shows on demand. You get some early taste, some early dose of shows. And when we record them and they're going to come out a week or so later, guess what? Our pro folks get access to them early. So a lot of cool stuff. Check it all out for yourselves. Theoptionsinsider.com/pro is the place to go to learn more. And of course, keep hitting us up with those questions, those comments, those insights, those pearls of wisdom. We do love to hear from all of you guys and gals out there. Let's see who we're hearing from on the show today. I am pleased to be joined once again by the black-hatted one himself, Mr. Dan Passarelli, the founder of Market Taker Mentoring, author of 1 or 2 or half a dozen options-oriented tomes. Mr. P, welcome back to Options Bootcamp, sir.
Well, hello. It is great to be back, Mark. How's it going, friends?
It is going well. I'm excited to see what the friends have on their brain for us today. But before we do that, I know, Mr. P, a lot's lighting up your world over there at MTM. What are the folks coming to you for these days? What are the hot topics?
Oh, man, things are going pretty darn splendid over here, Mark. I got to tell you, we're just teaching the world options one person at a time, one class at a time, and helping move people forward, take control of their financial lives, man. And I love it.
I like it. And nothing lighting up your tape. And we're kind of in this kind of weird zone of will they, won't they in the overall market. You know, we had some rallies, some sell-offs, market rallying again today. Vol has mostly been trending lower with a few brief blips to the upside. Come into Showtime, you got VIX cash around a 16.5. So no longer a 15 threatening a 14 handle, but still has come in quite a bit, Mr. P. What's been lighting up your tape on this march to the upside in the indices and the march to the downside in volatility?
Well, it's been a little bit interesting because we've got the Fed that's a whole bunch more hawkish than they have been in the past, which kind of surprised people a little bit at the last Fed meeting. And we expect interest rates to go up higher than we thought. But what's really interesting about that is that stocks like Apple, Amazon, and DoorDash, some of these tech companies, have really had a pretty good run the last week or two. And with the specter of interest rates maybe heading a bit higher, that seems a little surprising to me. And so I wonder if we're going to get a pullback in some of those big tech names.
People have been wondering that for a while, and we shall all wonder what you folks have on the brain. But you know what? We don't have to wonder anymore, because it is time, listeners, to roll out the mail call.
Mail call. Time to look at questions submitted by our listeners.
All right, everybody, let's do it. Let's unleash the masses here on Options Bootcamp. See what you have on the old brain. Remember, our Pro and Plus folks get bumped to the top of the list, like our friend here, Nichols. He wants to know, hey, Bootcamp dudes. Well, hello, Nichols. Says, been boning up on my back catalog of shows and listening to the discussions about calendar spreads. I also heard the recent Pro Chat with Don S. That was our recent Pro Q&A from a week or two ago, listeners, where we had Don Schlesinger, who's very legendary on the short vol side of the fence. And as Nichols points out, he also had a dim view of calendar spreads. You are correct there, Nichols. He wants to know, why are these things so befuddling to so many people? Calendar spreads. I've often referred to them as the options 201. Some folks may even say the options 301. They are a wee bit more advanced, and as you put it, I like it, befuddling. They are befuddling to a lot of people. Think about it, Nichols and everyone else out there. You buy an option, you buy a call, you buy a put. You have a pretty straightforward sense of what you're looking to happen with that trade, right? If you buy a call, for a lot of people, they're looking at it from a directional perspective. They want the underlying to go up. They buy a put, they want it to go down. You buy a vertical all in the same month, same deal. You buy a call vertical, you want the underlying to go up. You buy a put vertical, you want the underlying to go down. We can get more nuance with time decay and volatility, but that in a nutshell is what people are really looking for. And they could wrap their heads around that when you're looking at some of those basic trades. Now you get to a calendar, and now you're rolling things out. Now you have two expiration cycles at play at the same time. And that's what I think, to use your terminology, befuddles people. Take your traditional calendar, right? You go out a month. Let's say you go out 2 months, and you buy, the at-the-money call, and then you sell the 1 month at-the-money call against it. What do you have now? You have two positions, right? You're long a contract that's farther out. You're short a contract near term. So you're long vol, but you're short gamma. You kind of want the underlying to move because you're long vol, but you don't want it to go anywhere because you're short gamma. So there's a lot of these contrasting things at work in a calendar spread that for a lot of people are not easy to wrap their heads around. And so I think, Dan, it makes a lot of sense to me why people are, quote unquote, befuddled by calendar spreads. Do you find calendar spreads befuddling? And also, a lot of people come to you at MTM. Are they, quote unquote, befuddled by calendar spreads? And what are your thoughts here from Mr. Nichols, sir?
Oh, so much befuddling. There's befuddling left and right around here. Befuddling all over the place. My take on calendar spreads is they are one of the most powerful trades that you can have. You can get a lot of edge with them and put on some really statistically sound trades. But like the only, I don't even really want to say caution, because I'm a gigantic fan of calendar spreads, but the only, I guess, caution is a lot of people oversimplify them, and it leads them to poor results. They're a bit more nuanced than it comes across on the surface. A lot of people look at the textbook picture where it's like, this curved line on this side, curved line on that side, and they say, oh, okay, it's got to be at the strike at expiration. I get it. I'll put it on. But if you want to do it with any semblance of an edge, do it like a professional, do it in such a way where you can reasonably expect to win long term. There's just a lot more to it. The volatility really comes into play. It is not the most important thing, but it is an important thing.
Yeah, you're looking at the term structure of this name now, which is not something you really have to worry about if you're trading all in the same expiration month with a vertical, for example. You're just looking at the skew there. You're not looking at the term structure. Now the term structure comes into play. Is the month you're buying bid up over the month you're selling? You hope so. That's what you want in those types of environments. Or is it cheap? Is the month farther out, cheap compared to the one you're selling, right? That's kind of the situation you want. And of course, you have this weird structure where you're buying something, but you don't really want it to move. That's contrary to a lot of people who are used to buying premium because they want something to explode. When you buy premium, the thing needs to move, right? We say it all the time here on this show. Now you're buying something and you want the underlying to just sit there. You want things to come in. That's very contrary as well. So there's a lot of reasons, Nichols, why I think calendar spreads are quote unquote befuddling. Again, even Don really didn't have a lot of success with them. He moved on from those trades. So they're not for everybody, but they are an interesting strategy if you can wrap your heads around. If you're confused or befuddled, as Nichols says, by calendar spreads here, listeners, go check out the archives of the show. We have spent a lot of time doing deep dives into those. And I'm sure just the fact now, Dan, that we've invoked calendar spreads here on the show is going to open up the floodgates for a whole bunch of more questions. What do you think?
Oh, I think that sounds great. So let's bring it on, man. I actually really like talking about calendar spreads because they are nuanced. There's a lot of little nooks and crannies of knowledge to get into. So, bring on your calendar spread questions.
Yeah, well, be careful what you wish for, sir, because now they're coming. They're coming right now as we speak. All right, let's go on. Let's get away from them quickly before more calendar spreads can get at us. Next up, we've got exclusive. No E, I like that. Says hello. Well, hello, exclusive. New listener alert. Well, welcome to the party, exclusive. Loving the show so far. Well, glad you're having fun. He or she goes on to write, still new, but was confused about Dan's comments, RE portfolio margin on the last OBC. Why does he perceive it as dangerous for new traders? Looks like we have a couple about portfolio margin. It's got a similar one here from Milky with an I. I guess we'll just do both of them together here, Dan. Milky with an I wants to know. He says PG. I think he means PM for portfolio margin. We can go for PG. Maybe he thinks it's parental guidance. Why is portfolio margin locked to accounts above 100,000? Seems somewhat limiting. If it's better, why not open it up to more accounts? Yeah, this is going back to our last episode, listeners, where we talked about Reg T, kind of your traditional type of margin and how it's not really the best. There's some standard percentages that they're going to hold in reserve, almost regardless of what else you have in the account that could potentially offset that risk. Portfolio margin does a much better job of accounting for offsetting risks and offsetting positions. But also, as Milky points out, it usually requires more capital. We talked on the last show, IB requires you to have 110,000 in the account. TD requires 125,000. It's going to vary by broker, but it's usually somewhere north of 100 grand for a lot of interesting reasons. But Dan, as what was it? Exclusive points out, exclusive. There's no E. I like that. You were a little bit more hesitant to recommend it. So let's start there. Why did you, I think you called it enough rope to hang yourself. So why do you have that kind of view of portfolio margin? And then B, the related question from Milky, why is it locked to only accounts over 100 grand?
I think I specifically said they give you enough rope to hang yourself and then give you another rope.
Yes, I think you did say that. You're right.
Yeah, I mean, look, man, if you have a lot of experience and you're smart and you've got your system down, portfolio margin can be great for you, man. You can really ramp things up and have your trading really be a business. But, there's this often cited statistic that something like 95% of traders lose money. And it's true because most traders are not like you, the folks who are listening to this podcast and putting in the effort to learn and investing in yourself. A lot of people, they get some recommendation from a Reddit thread and put all their money in there. Like I just literally got a message from Reddit from one of the things I subscribe to, and it was talking about somebody was like, "Oh, I've got half my life savings in Wish, YOLO," and then like within a couple of days, there's another one that said, "Oh, I've got my father's inheritance in Wish." It's like, are you kidding? Like, why would you do like that's absurd. And so people make bad decisions. And I mean, look, man, I'm definitely like a freedom sort of guy, like I want people to have as much personal freedom as they as humanly possible. But geez Louise, man, sometimes you got to protect people from themselves, because the thing is with Reg T margining, generally speaking, you can only lose what you put into it, or, what is withheld with margin. It's not 100% true 100% of the time, but you're protected from yourself. Like, you can knock your account down to zero. But with portfolio margining, if you're just completely reckless or just not educated enough yet, you could end up bringing your account down below zero. And for people who are extremely reckless, and lose hundreds of thousands of dollars, millions of dollars, which is possible, your brokerage firm is on the hook, and that can threaten the financial system. So, I mean, look, there does need to be some rules that protect investors, sometimes from themselves, and there do need to be some rules that protect the system. And so, I think it's okay to wait until traders are competent enough and capitalized enough in order to be granted permission to have all that extreme power. Really, it's just a lot to handle otherwise.
It is a lot to handle, and that's one of the reasons that they gate it behind the larger scale accounts. You can't always say the higher account balances are the quote unquote more sophisticated customers, but that's one of the easy ways for them to gate that and say, okay, higher account balance, maybe they're a little bit more sophisticated. We can allow them to have, as Dan would say, the rope to hang themselves and then another rope. It's also, there's a little bit of effort on the part of the broker to assign and allocate resources to this. When we talk about the real-time margin calculations, everything else like that, that's not free, nor is it really trivial from an analysis and an analytical perspective. So they're putting some effort in on its behalf. So they want to make sure it's for an account that's going to be worth it, not, a couple of grand account that's going to blow out in 2 weeks because they're all loaded up on Wish. By the way, Dan, all those folks who are loaded up on Wish are looking good today, off nearly $1 or 8%, $10.95. So I guess the kid's going to community college, sir.
Well, the world needs ditch diggers, Mark.
Hey, where would we be without the finer ditch diggers of society? All right, next up, this is an interesting one. This is something I've been kind of mulling over for a while. A lot of people have been asking various flavors, wanted to get our thoughts on this. This particular question came in from Lauren K. Messerly. She says, can you guys do a podcast that goes through the recent Robinhood FINRA ruling and explains the violations? Lots of options talk on pages 5 through 20 of the ruling. And she included a link to the FINRA ruling. If you've been living under a rock for a while, listeners, you missed out on the fact that Robinhood, not so good when it comes to the options side of the fence. And we talked on this show not that long ago about the unfortunate case of the customer that actually committed suicide, due in no small part to the just completely boneheaded way that Robinhood handled options and margin on their platform. And Robinhood knew this was coming. They knew they had taken some hits. The SEC already fined them $65 million. I'm not sure if the SEC fine is separate exactly from the FINRA. I think you need to dig in a little bit. That's more along the lines of payment for order flow and ripping off customers from that perspective, or in the terminology, the parlance of the SEC, depriving customers of $34.1 million. They said even after taking into account the customer savings from not paying a commission, so the SEC fined them $65 million. That's our historic fine. And then I do believe this is separate, even though FINRA does work hand in hand with the SEC. This is for a different issue. This is FINRA. If you're not familiar, listeners, FINRA is a financial industry regulatory authority. It's a self-regulating body, but it has, as you can tell, has some muscle, has some teeth to actually levy fines. So Robinhood set aside $26 million to cover in their IPO filing. Said, hey, we might have to pay some fines. Turns out it wasn't even close. They $70 million just for this FINRA deal, the largest ever penalty in the history of FINRA. So there's some bad stuff going on here. And as you pointed out here, Lauren, there's a lot of quote unquote options talk in this filing. So let's go through some of this, Dan, and I'd like to get your thoughts on this as well. I was kind of just paging through this lengthy filing on the many things that Robinhood did wrong. we're just talking about margin. So let's start there. One of the first things they did wrong that FINRA fined them for was misleading customers on margin in their accounts. As they put it, they negligently communicated a wide array of false and misleading information to their customers, including, among others, they had a platform called Robinhood Instant. And they told Robinhood Instant customers they had to upgrade to Robinhood Gold to trade on margin. And in fact, that was a lie. And Instant customers could place options trades that could trigger the use of margin even when they weren't approved or qualified for it. They falsely told Robinhood Gold customers that they could, quote, disable margin in their accounts. So someone could come in and say, I don't want to trade on margin for whatever reason. And they said, yes, you could do that. And then they still let them put on trades that would require margin. In fact, I do believe that's one of the things that unfortunate customer who killed themselves, they thought they had disabled margin. And turns out, no, it's a difficult thing to do, particularly if you're allowing people to do a lot of different spreads that you could get assigned on a short leg. And guess what? You need margin to cover that. And that's kind of where they ran into problems. So that's one of the first of many problems. And here's another good one, Dan. They used, this is so kind of web 2.0 app mentality kind of thing. You know, a lot of brokers have streamlined the options approval process these days. I've joked about that before, how ridiculously easy is pretty much anyone to come in and get level 3 these days. But Robinhood took it to another level. They used bots to approve options accounts. They said these bots were programmed to approve options trading based on inconsistent or illogical information. This is from FINRA. These are FINRA's words, not mine, listeners. Including for customers who were younger than 21, but claimed to have had more than 3 years experience trading options. So again, we know that's not right. The bot couldn't pick up on that. The bots approved certain customers with low risk tolerance for options trading, even though the firm's written procedures prohibited that. They wanted to have some sort of risk profile for their options customers, yet the bot didn't do that. And this is one of my favorites, Dan. The bots were programmed to only take into account the most recent information provided by customers, meaning that the firm approved for options trading customers that it had previously rejected for options trading, often only minutes earlier. So you came in, maybe you filled out the form honestly, saying, I don't really know what the hell I'm doing, and the bot rejected you, as it should. And the person could come right back in, change all of their answers, and get approved 30 seconds later. As a result of these flaws and Robinhood's overall failure to exercise due diligence before approving customers for options trading, the firm has approved thousands of customers who did not satisfy the firm's eligibility criteria or whose accounts contained red flags that options trading may not be appropriate for them. So FINRA negged them for that. So Dan, what are your thoughts on those two? Then there are many more, sir.
Oh man, Mark, I mean, just looking at all this stuff, it's really disheartening, man. I mean, it's always my hope that people who are big players in our industry are doing the right things. And I don't know if Robinhood just had gross incompetence or if they're intentionally doing the wrong things. It kind of almost seems incompetence, but that's not even much better than intentionally doing something wrong. Like I just don't understand how, like, still to this day, like they don't take their shortcomings, let's just say, more seriously. I just wish that. Yeah, I don't know. I don't even know what to say sometimes.
Yeah, you know, this to me is so emblematic of a lot of this, you know, kind of Silicon Valley startup mentality. You build a platform, you scale it at any price, right? Just grow it as fast as you can so you could flip it to the greater fool, which is the public. And that's, of course, what they're trying to do now with the IPO. So they're just going to eat up all these fines because they have to get to that IPO. They have to get to that liquidity event for their early investors. And, you know, damn the consequences, including this. They allowed over 800,000 customers to use margin who either didn't want to or couldn't or shouldn't have. They approved 818,000 customers for options trading that didn't have margin ability or shouldn't have been allowed to use margin ability. So that gets back to them saying you have margin turned off when you don't. They also say that customer who killed himself thought he had, quote unquote, turned margin off, which is one of the reasons why he was so surprised when he got hit on that spread. He thought he had disabled all of that. So those are literal tragic consequences as a result of this kind of scaling at any cost. And it gets even worse, Dan. Here we go here. This is another thing FINRA flagged in this epic report. And I encourage you to check it out for yourselves if you are intrigued listeners. It's a lot of reading, but we'll kind of hit the highlights for you here. But it is pretty damning stuff. They say Robinhood misrepresented, just straight out falsely misrepresented the risk of options trade. FINRA says Robinhood negligently misrepresented the risks associated with option spread actions and the actions which firm would take with those positions on the customer's behalf. I mean, so first off, they talked about the potential for loss with option spreads. They just posted things that were flat out incorrect on their sites. They told people you could not potentially, there's no scenario where you buy a spread where you could lose money if you spend money. All you can, the only risk is the outlay for that spread, when we know there are some scenarios where that is not the case. They say as a result of these negligent misrepresentations and omissions, at least 630 customers incurred losses totaling nearly $6 million. And then this one to me is just flabbergasting, Dan. They lied about closing out positions prior to expiration. So FINRA goes on to say, in addition, on its website and emails to customers, Robinhood falsely assured customers that they did not need to take action to mitigate risk in the days and hours preceding options expiration. Everyone knows even like a low rent broker is going to send you some sort of notice. Hey, you have options expiring soon. Maybe you want to pay attention. Maybe you want to do something with it. Robinhood says, don't worry. We'll take care of it for you. On its website, Robinhood informed customers that if the stock went, quote, below the low in the case of call credit spreads or above the high in the case of put credit spreads at expiration. I love this terminology. Robinhood would, quote, automatically let both options expire worthless, so you don't need to worry about checking the app. These statements failed to disclose that if customers relied on Robinhood statements and did not close their positions, their short options could still be assigned, resulting in loss. So they told people, don't worry about it. Don't sweat it if you have short positions going into expiration, because if they're out of the money, we'll just let them expire worthless for you. Not even mentioning the fact that anyone could come in and exercise those, and they could be hit on that position. Moreover, during the week that customers' options contracts were due to expire, this is good, Robinhood sent customers emails stating that for short options positions, you've already set aside the appropriate collateral for assignment. This statement was false in that it did not account for the fact that customers needed to take additional action to mitigate the risks in the days and hours preceding expiration. And they say many customers who have relied on Robinhood statements experience significant losses. They talk about a specific example on September 4th of last year. 130 Robinhood customers had short Tesla spreads, incurred huge losses because they were signed on their short options after hours while their long options expired worthless. Yes, that's exactly what could happen, and Robinhood said it can't. On average, these customers lost tens of thousands of dollars, even though Robinhood had informed them that their maximum losses would be a fraction of that amount. And this is the one I can't believe. Robinhood also falsely told customers who had entered into option spread transactions that the firm would sell rather than exercise their long options if they did not have the buying power or underlying shares necessary for exercise. In fact, Robinhood exercised many of those customers' long options anyway, causing the customers to incur significant losses. So they sent you an email saying, don't worry about it if your thing goes in the money and you don't have the cash to cover it, because we'll just sell it for you. And then they didn't even do that. They just straight up lied to people. Isn't this stunning, Dan?
Yeah, you know what? It really is stunning because I'll tell you what, like when a lot of this meme stock GameStop stuff started, my son was kind of one of the millennials who was jumping in on this stuff. And he was like, yeah, this is something I read on Reddit. And like they would often criticize the industry. And he would say, well, is this true? And I'd, look at it. And sometimes it's just like something I was extremely intimately familiar with. And I'd say, well, no, that's not really right. Sometimes I'd have to look it up. And I did a lot just because I was very curious. And, like a lot of times those guys got it really wrong. Like they were just not like they didn't really understand how it worked. And they were kind of like beating up the industry, not really rightly so in some cases. But then when FINRA comes out and they really did their due diligence and found what's wrong and found all these blatant, just, I don't know what else to say. you know, it kind of makes me mad, because I think that options sometimes gets a bad rap by a lot of people who don't understand it. And I spend a lot of time defending the virtues of it and all the good that comes out of it. It levels the playing field for the average Joe to the options pro. Like, you have the exact same tools that billion-dollar hedge fund people have. And then, when you have this, like, man, it does kind of make me mad. I want to defend all the great things about it, and when there's things that are going on that are certainly not great things, it's frustrating.
It should make you mad. It should make everyone who listens to this should be furious about this. If you're using Robinhood right now, you should stop. This is terrible. This is all terrible behavior. This is a terrible way to handle customers. Again, this is scaling their platform at your expense, quite literally, listeners. The SEC already said they ripped off their customers to the tune of 35 million, and then they fined them 65 million for bad order routing, which again goes back to the earliest days of Robinhood. Everyone in the industry said, hey, if you're not paying for it, then guess what? You're the product, and they're selling your flow aggressively, and that's exactly what happened. And the order routing was terrible as a result. And now FINRA coming along, looking at the actual transactional side and saying, yeah, the options side, no bueno. There's more, Dan. We're not even done here. So in addition to talk about the bots approving accounts, they lied about who was actually overseeing that. They're supposed to, in their documentation, they say they have registered options principals overseeing the approval of accounts for options trading, but that's not true. It's actually bots. The actual review process of reviewing these accounts that were approved by the bots, and again, these bots are spitting out thousands, tens of thousands of accounts per week. They say these actual principals only reviewed about 20 options accounts per week were actually seen and reviewed by a human. They say principals at Robinhood review on a weekly basis less than 0.1% of accounts to ensure that the bots function as programmed. Let's see that the firm's team of principals previously reviewed only 20 applications per week. So they tried to jump that up now to 500 per week, but still, it's kind of, the horse has already left the barn here. So, and then in addition, perhaps most disconcerting, another reason why you should get the heck out of Dodge, listeners, if you haven't already, is that these problems, a lot of them are still happening. They say, FINRA says, although Robinhood implemented a bulk downgrade process in April of 2020 and revised its options eligibility criteria in September of 2020. So they took a bunch of options people that they had approved, downgraded them away from options, or I guess to a lower level of options approval, and have increased their criteria. They say this is still a problem. They're still approving customers based on inconsistent customer information. And so now they have to keep doing this monthly bulk downgrade process to go back and fix the problems that they caused by approving these people who shouldn't really be trading options out there. And then on top of that, and FINRA also goes on, we won't get into this, the legion of serious outages that Robinhood had where they prevented people from trading and closing their options position. That's a separate conversation, kind of outside the scope of this show. It's more on the technology side. So yeah, Robinhood set aside $26 million to cover these fines. They ended up paying FINRA alone $70 million. I know the SEC was talking about $65 million last year as well, after their probe of the order routing and everything going on. I'm not sure if these are going to be combined or $135 million in fines. That's horrific. That's a firm that is aggressively harming consumers at that point, listeners, and you should not be working with them. You should not give them your money. You should vote with your dollar and get the hell away from this firm. There are a legion of good options brokers out there. And this kind of goes back to the notion, too, that sometimes you do get what you pay for. And in the option space, brokers were very hesitant to go down this low commission route for a variety of reasons. There are things that cost money to do option. And I'm not excusing brokers who gouge on commissions either. There should be some middle ground for this. And it seems like the industry has kind of settled out on this no ticket charge, but a base fee of around 60 odd cents a contract seems to cover a decent chunk of this out there. But then again, you have things like approvals, actual real life approvals, real life margin and responsibility, real life tech support that knows what the hell they're talking about, things on the website that aren't completely misleading or outright lies. These are things you should expect from your broker, and you should get the hell out of Dodge and go to a broker. Probably going to cost you a little more, But on the flip side, you're not going to have these issues here. You can't go to a broker in good conscience that has been fined $130 million by regulators in the last few years, and they're just kind of shrugging it off because they're just racing to the IPO. They're racing to the exit. Don't be a part of that, listeners. The options trading is hard enough if you do it with a real broker who knows what the hell's going on. You don't want a broker who thinks you don't have to do anything around expiration with short positions. That's idiotic, and it's dangerous, and you don't want to be around that. It's going to cause risk. Is it worth saving, a few bucks on a round lot here or there if you're going to blow out on Tesla options? Probably not. So, Dan, we could probably go on this for a while. I hope who sent that in. That was Lauren. Hope, Lauren, that kind of is at least a bit of a synopsis of the options related. Again, FINRA cited a lot of other issues with Robinhood as well, which was the sum total of the reason behind this historic $70 million fine. But there was a lot of options within that as well. We kind of broke down the main issues on the options front. Dan, anything else to add on this just litany of horrors that is the FINRA report on Robinhood's options dealing, sir?
Yeah, I mean, I'll kind of expound upon one thing that you kind of alluded to here. Like, commissions aren't everything, man. If you save 60 cents and it ends up costing you $10,000 because somebody gave you crappy information, like that math doesn't work very well. So, shop around. There's plenty, there are brokerage firms who educate people for free. Thinkorswim, they used to literally fly around the whole darn country putting on free seminars to help people understand trading better, because they want their customers to make money. Look, man, when I was down on the trading floor, the commissions that I was paying, kind of like exchange fees and such, were actually pretty comparable to what I'm paying now in a retail account. I mean, I don't freaking care about 60 cents a contract. It's nothing. So yeah, to me, there's so many bigger things to worry about than commissions. And when you're getting false information, you're getting blatant lies, you're getting things that cost money and management that doesn't really seem to care about it. I'm in Mark's camp, whoever that broker might be, that's part of your due diligence. And, I think you should take Mark's advice and download this report, read it for yourself, and see what you think about it, and see if it's a firm you want to do business with.
Yeah, if $135 million is the cost of doing business for them, then you don't want to do business with them. Get the heck out of Dodge. Dan, we could end on that, but that's kind of a sour note. Let's end on something happier and more out. Let's go to this one here from Marie. She wants to know, any new books on the horizon for Dan? So, Mr. D, you got any new tomes in store for us, sir?
Oh man, I got this one that I want to write, but I'm just trying to find the time to commit. I probably mentioned on the show like a year ago, and haven't even moved on it at all.
Is that your autobiography of Mark Longo from the early years till now, Volume 1? That the one you're talking about?
Yeah, the expose. The
Rise of the Options Insider, Volume 1, the early years.
Right, exactly. So nothing just yet. Nothing just yet. I got one, but we'll see.
Well, that's kind of a inauspicious note to end on. I tried, Marie. I tried to end on a more positive note. Dan would not oblige me. At least we know, though, he is starting to work on the most important tome, which is Autobiography, Volume 1 here. All right, good stuff. I guess it's more of a biography if you're writing it about me. But I will have some input, so therefore it is a semi-approved autobiography. But I digress. That music means we've come to the end of this one. I know it kind of turned into a bit of a anti-Robinhood screed there at the end. To our credit, I've tried to give this firm a pass. I've heard a lot of things, and I was very skeptical early on when they were trying to embrace this business model that has been tried in the past many times, almost all of them failing. I thought, let's try it again. Let's see. And to their credit, they have brought a lot of people into the options fold. unfortunately, they did it in unscrupulous ways, and they did it costing people a lot of money. And it's a bad experience for all involved. We don't want a broker that's preying on the customer. We want a broker that's out there that has a vested interest in you being a long-term, stable customer, not someone that can just churn and burn you for whatever enterprise value they think exists in your account, then move on to the next one. Also, they could race to an IPO. You don't want to be an exit strategy for your broker. You want to be a lifelong partner, right? So, yeah, none of this is good, unfortunately. It's a great question, though, Lauren. I'm glad you sent it in. You're not alone in wanting more. In fact, I don't think this is the last time we're going to chat on it. I'm sure other folks on the network have thoughts on this. Maybe we'll bring it up on Option Block and some other stuff tomorrow. But before we go, Dan, outside of all this madness afoot out here, if folks want a respite from this, they want to go somewhere, they can just talk options. Where should they go? What should they do, sir?
Well, I like nothing more than talking options, so you're in the right place, and you can find me real easily on the internet machine by surfing your way on over to markettaker.com and just hit the contact us, and we would love to chat with you if you have any questions. That is exactly what we're here for, and you can even join free and get an account and join our chat room, get some trade ideas, talk with some of our really experienced students. And I think you'll like that aspect as well. So we welcome you in advance.
There you go. MarketTaker.com. Dan's not going to churn and burn you for your enterprise value, right? Dan, you're looking to build a lifelong relationship, right?
There's no other way to run a long-term business. It's not a money grab. I've been doing this 13 years. And I think that we have the best trader community in the world. I know I'm a little bit biased, but I'm pretty sure that's true.
But that said, you are scaling towards an IPO, correct?
That's right. We're looking for investors.
Look for his IPO filing soon. You can find it for yourself. MarketTaker.com, 2 T's, is the place to go. On behalf of Mr. P and indeed myself, I want to thank all of you out there for downloading, streaming, subscribing, for listening live. I'm sure many of you have maybe are you a user of Robinhood? What's your experience been like? Hit us up. Let us know. I'd be curious to hear what you think. Is this coming as a surprise to you? Is this kind of what you expected, given your experience with the firm? I'd be curious to hear your thoughts. I know a lot of you have them out there. And, of course, later on today, if you're listening after the fact, you'll get your second dose of Education Wednesday. Brian and I did a sweet huddle last week. It was really fun. If you're a pro listener, you already got it on your exclusive pro feed there. Of course, back again tomorrow. The Option Block. Again, I think maybe we'll be touching a little bit on this tomorrow as well as TWIFO, Friday vol views, and then options oddities. And we're back again next week all the way through to another Education Wednesday, another episode of Options Bootcamp.
You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com.